Hey everyone, this is Megan.
And Darla. We are your hosts of the Enlighten Benefits podcast.
Our goal is to help you understand all things insurance. In each episode, we will tackle the confusing topics and terminology as it relates to insurance.
We want to create confidence over confusion and make insurance suck less.
We hope you enjoy our show. Hey Darla.
Hey Megan.
I like your orange.
Thank you.
Very pretty summery spring color.
Yep. I just wanted to pop today.
You're popping.
Yep.
Today, we have a very special guest with us again. We've got Greg Hawley. We didn't get to finish our conversation from last time, so I wanted to have him back and visit a little more.
Thank you for having me back. Enjoy
Absolutely. Hey, Greg, tell us who you are and what you do.
Greg Hawley. I own a company called Flex Plan Administrators here in Tulsa, and we partner with broker firms such as yourself to help administer different elements of benefits.
Awesome. So the last episode, we talked a lot about HSA and FSA, flexible spending account, health savings accounts. A couple of other questions that we had were as they relate to HRA. I don't hear HRA, the acronym, very much in practice today. Could you tell us what that stands for and maybe what an HRA account would be used for?
Sure. So HRA, very similar to what we talked about previously, it's another tax benefit, tax deferred type of an option. But it stands for health reimbursement arrangement or health reimbursement account. You get different versions of it, but that's essentially what it is, HRA, health reimbursement account.
Okay. And when would an HRA account be used over the other two options,
Sure.
meaning an HSA and FSA?
Correct. So you can have, for instance, the flexible spending account, you can actually have it with an HRA. The big difference between the health savings account and the health reimbursement card, a lot of acronyms here,
right?
Is whereas an HSA is owned by the employee, a health reimbursement account, the HRA, is owned by the employer. So that's a critical difference is the HRA employer owns. And there's several different kinds of HRAs. And really, the company, because they own it, they really set the rules. And so there's some compliance parts of that, as long as they dictate kind of how that works and make sure they explain it to the employees, they really can make it work however they want. Most common type of HRA we see is used kind of like what would be called like a gap type plan.
Okay.
So for instance, you have an employer that has, maybe they want to have a deductible for their employees set at a higher amount.
Okay.
But yet they want to have their employees experience a lower deductible.
Yes.
And so that's where you can use an HRA to kind of complement a higher deductible premium for the employer cost. And then the employee, I'll use easy numbers here. So say the employer's deductible plan is $4,000.
Okay.
So that means once the deductible kicks in, that the plan will, once they reach that amount, the plan will kick in. So whereas maybe they want their employees to experience a $2,000 deductible. Mm-hmm. So what you do is you set up a $2,000 HRA, meaning so between $2,000 that the employee hits and then the $4,000 for the plan, that HRA kicks in.
I see. So how would the rules be the same for every person? I mean, goodness, if I, spend every single person within my organization, which we know that's not going to happen, right. But if we all hit our $2,000 deductible for the year, would the company be responsible for that? Or is it, you'd have to turn in certain receipts, or how does that work?
Right. So there's going to be a process that the company would establish, and it is in kind of the way you describe it there, it's a little bit of a risk, obviously, but as we know, most people don't hit their deductibles. And so, if the company can have some savings on what they would pay an employee on their contributions on the premiums for that higher deductible, mm-hmm. but yet the employees, again, experience a lower deductible, the only real downside is if everyone, as you mentioned, hits that amount. And yes, they would have to pay that. They have to be consistent with it. But there would be a process established as well as the rules. So, and a company can come in and say, you can use it for premiums. You can use it for, co-pays, for instance, out of pocket. You can use it for dental and vision, or you can say it's medical only. It can be for prescriptions only. The company can establish the rules of what they can be used for.
Okay.
They just have to be consistent with it. Okay.
So it has to be the same for every person.
Right.
So another possible downside I could see is, I could assume that most employers are going to do that HRA for the employee. Likely not for dependents, spouses and dependents. And so would that be true in your practice that you see most of the time the employer has that HRA set up for their employees?
Yes and no. I mean, they do. A lot of times they'll set up different tiers or different parameters.
Okay.
So you'd have a family option, for instance. Maybe there's a set amount that is for if you're enrolled in family coverage, and a different amount if you're enrolled in individual coverage.
Okay.
So generally, there would be scenarios to cover whatever coverage they take.
I was going to say the only downside I could think about that, Darla, is if we've got, we actually work with a lot of clients that do take care of their spouse's independence, and they'll contribute, maybe even 50% of the premium for dependents and spouses. So I could see where they would think, man, that's kind of a lot for a $4,000 deductible if that wouldn't be helped with, the families.
Sure.
So.
Yeah, and the amounts can be, I just use those random numbers.
Sure.
It really can be whatever they decide to do. The big advantage is the cost savings of the employer, premium. What they would be paying in premium versus whether the employees really needed that deductible. And so you can kind of take advantage of some savings there if it's used right.
So unlike the HSA and FSA, there's no employee contribution opportunity
Correct.
Here, right?
Right.
Do you see that an HRA can work nicely with any of these other products that we talked about, an HSA, FSA, or no, it needs to stand alone?
It's funny. Yes, they can. I wouldn't say always nicely because it can be confusing.
Okay.
We're talking about HSAs, FSAs, HRAs, and I'm in the business. We are, and we're confused by it. So,
right.
But that being said, it can be.
Okay.
So the HRA can actually use, it plays nice with the other benefits, except really the HSA piece of it. So the FSA and the HRA can work. You can make one of them priority over the other.
Okay.
And so there's some tracking that has to be involved in how it would work and what pays when. Just because depending, again, the FSA, someone's putting their own money in, whereas the HRA is the employer money and it's tied to a different type of a plan.
Right. I can see that accounting wise might get a little messy.
Sure. Absolutely.
Well, and also on your app, as you're trying to follow all of that, where's my money and what do I have to spend? Could get a little dicey.
Sure. And not to confuse things even more, but the government did create two new types of HRAs that even have longer acronyms. Qualified Small Employer HRA, which is called a QSHRA. And this is in 2020, they started these, and then a new one called the ICHRA, which is the Individual Coverage HRA. And so we're starting to see a lot of those. They're popular for smaller size companies.
Okay. Is there any major difference with either of those as they relate to an HRA, or what do we need to know, very high level about those two plans?
They're really just different types of HRAs.
Okay.
Again, as we talked about before, the HRA can be so unique depending on how the company sets up. These two in particular do have some set kind of parameters and some rules to follow. And I'll start with the ICHRA. It's probably the most popular of them, just it's still very new. And the nice thing with it is you can have one employee and have an ICHRA. And really what it's doing is it's allowing the company to set aside an HRA amount to then allow it to reimburse their employees for whatever coverage they go out and take on their own. And so they're not really taking group health insurance in this scenario. They're just reimbursing through it using the ICHRA. The nice thing with the ICHRA is you can actually have, I think there's 11 different classifications. So you can actually have different amounts associated with different, whether locations, for instance, say maybe you have employees in different parts of the country. And of course the insurances are different in those types of areas.
Sure.
So you can have different classifications. You can have departments, you can have, what their job role, their job function might be. And there's several different ones that are eligible, and you can have different amounts of benefit for each of them.
I see. So you could potentially reimburse, a senior executive of your company, $800 a month, versus maybe a, shop employee or just a different classification, maybe $400 a month. And that's completely legal as long as it's set up appropriately.
As long as it's one of the 11 category codes, if you will.
I see.
You can absolutely kind of make it kind of unique to whatever your company's needs are.
The only thing I've heard in practice about the ICHRA is to just be careful. We had previously on our podcast, we had an individual specialist on our podcast, and we just touched on that just a little bit. And I would assume that most people go to Marketplace to purchase those individual policies. And so she was just saying to be a little careful between, your subsidy that you're getting versus your ICHRA money. There's some rules and some guidelines around that.
Sure.
Yeah, just have to be careful.
And the other one, the difference in the qualified small employer HRA is with the qualified small employer HRA, it is tied to an employee count. So you're really looking like a 50 employee count rule for that one. And there are some set maximums that they can contribute in. So I want to say if you have individual coverage, it's like 5,450. And then up to, I think it's like 9,000 for the family, but something like that.
Okay.
And they do set the limits.
Okay. So if someone was going to do an HSA, FSA, or an HRA, do you have a suggestion, or would you really say it's just employer group specific and kind of what they're looking to achieve?
Really, you're talking about two kind of different scenarios. So from the employer standpoint, it's really what best fits their model of employment, what kind of benefits package they want to put together. And when you look at, I always look at the benefits package as a whole. You've got your core benefits, you've got your tax type benefits, you've got your ancillary complementary type benefits, all that type of stuff. So if they need that kind of a package for their employees, then that's where all these things can kind of come in and work together. If they're wanting to maybe not get into the idea of offering the group health plan, then maybe a qualified small employer or HRA or ECO would be good. Or if they're wanting to be creative, say for instance, as a broker, you want to be creative with your employer, that's where you go in and do the standard HRA and you try to figure out how to maybe play with that gap there and save them some money on their premiums, yet still be able to offer a good core health plan.
I'm going to switch gears on you. Do you have anything else that you want to allow on the HRA,
No?
HSA, FSA, blah, blah, blah?
Yes, it's a lot of letters. It's confusing.
The ABCs.
Right.
Let's turn the corner here, and another plan that your group administers is Cobra. So let's talk a little bit about Cobra and, first of all, tell us who needs Cobra. It is tied specifically to a size of group. So what is Cobra and who would need that?
Sure. Okay. So Cobra, it's mandated, to be offered, as you mentioned, for certain size groups. And so really the baseline is if an employer has 20 or more employees, or average 20 or more employees over the span of the last 6 months. So if you kind of do the math, if you've averaged 20 or more full-time employees, then you are required by law, if you're offering a group health plan, to offer Cobra.
Okay.
And really what Cobra means, just gives an employee and their dependents the opportunity to keep a medical plan.
Okay.
And so the most common Cobra event, and there's several different events, but your most common Cobra qualifying event would be a termination of employment, obviously. So somebody's working at ABC company, they get terminated, they were on their medical plan, they would then, unless they were left based on like gross misconduct, they are by rule required to be offered Cobra. And that then allows them to continue the health plan that they had, but on their own. So they're now paying the full premium, whereas not getting that, whatever that contribution might have been from the employer, but at least don't lose their coverage.
Right. And I think that's a huge aha moment for a lot of employees when they receive that Cobra documentation in the mail and they're like, oh my gosh, because a lot of times, the employer is paying 50% or more
Absolutely.
For your coverage. And then you get this $1,200 bill in the mail and it's like, oh my goodness, I didn't realize how expensive my health insurance.
100%. The employers don't oftentimes get credit for some, when you think about, what you make in a salary, a lot of times employers don't necessarily show them what they're paying for their medical insurance or their dental insurance, and that adds up to be a big number. When you get a Cobra letter and you see essentially 102% of what the premium is, they have to pay that. It's expensive, but you've got to have insurance, and so depending on the scenario, you at least need to make it available. And what we see with Cobra, there are some time limits on how long they can take it. So most common one would be 18 months, but rarely do you see someone stay on Cobra that long.
Right.
Usually it's for just a short period of time until they find a new employment, or maybe sometimes even their employer would pay their Cobra premium for a period of time while they're maybe in a waiting period with a new job, that kind of stuff.
Okay. So we've established the fact that, if you are under or over average number of 20 employees, and then how long can I stay? I think you just said this.
So 18 months is the most common. There's different timelines. It really can go up to 36 months depending on the circumstance. 18 month, a general termination or reduction in work hours for an employee at the employee level, the standard would be 18 months.
And
I was going to say there's some scenarios where you can get into like spouse, maybe someone becoming Medicare eligible, or their employee maybe deceased, and you're talking about the spouse needing coverage. There's some scenarios that would go out to 36 months.
And we, Darla and I did see with a few of our clients during Cobra, with that, you mentioned the reduce in work hours. And so we did see some of our employees, even though they were still employed by the organization, we actually saw them have to go on Cobra because of that severe reduction in their work hours. So that was not a fun time. Luckily, we're pulling out of that for the most part.
I would agree with that. And it's been, it's kind of it's a good and a bad in my mind, because we picked up a lot of Cobra business, a lot of Cobra clients over the last couple of years. But in part, so much of that is due out of necessity, because of everything that, the economy that's going through. So it's been a challenge from that standpoint. It means a lot of people were losing coverage, losing jobs.
Yes, unfortunately. Mm-hmm. So another question I've had in practice is, I had a gentleman that went on Cobra, and he was on, I believe he was on the HSA plan, but the company also offered a PPO plan. Well, he thought that was a life event. And so he was wanting to switch over to one of the other coverage, or I might have that reversed. He was wanting to switch over to a different plan. And I believe he was on the PPO and wanted to go to the HSA because the premium would reduce down. Is that a life qualifying event for someone to go on Cobra, and can they then switch around within the plan design?
At the next open enrollment.
Yeah. And that was an unfortunate, I think, an aha moment for him as well, because he was like one of those people that he was thinking, oh my goodness, my PPO plan by myself was like $1,200. And so then he quickly pulled out his benefit guide that we had provided. And his question was, oh, okay, well, I want to take Cobra, but I want to utilize this lower premium down here. And unfortunately, fortunately, we were utilizing FlexSource. And so you guys were graciously able to explain that to him. But unfortunate for him, we had to explain to him that this is not a life qualifying event. This, loss of your employment would not allow you to switch. However, at the next open enrollment, if the employee is still on Cobra, they can choose a different plan design.
Absolutely.
It's their open enrollment as well.
Exactly. It's a continuation of whatever is offered to the employees. That Cobra eligible participant has that same options available to them.
Even if your employer decides to switch carriers. So if you are currently with ABC, Blue Cross and Blue Shield this year, and next year we switch to Aetna as an employer group, then my Cobra employees have the opportunity to switch over as well.
Sure. Yeah. One thing on Cobra that's, because it's pretty straightforward. The rules are set. It's out there, but there are a lot of timelines and a lot of particulars that have to be met. And Cobra can very easily get lost track of if someone's not really paying attention to it. And the penalties can absolutely be pretty severe. Okay. And then you look at a circumstance, for instance, at an employee level, someone's terminated, and then maybe the company forgets to send in their Cobra notice. They don't get enrolled, and then they go out and they get into a car wreck, they get denied coverage, whatever it may be, and you can get into some sticky circumstances. So it's very important that you have your Cobra processes outlined.
Absolutely. If an employer is trying to do that on their own, kind of a rule of thumb, Greg, I will tell employers is I don't think it's a good practice. It can absolutely be done to process those Cobra letters in-house and to send those out. That's completely legal and doable. But I just always worry if you have that disgruntled employee, or if for any reason that relationship ended poorly, I don't think it's a great practice to process those in-house. I've seen it done very well. But what's your take on that as an outsider looking in?
I agree. So if you have an administrator handling it, they're really the ones collecting the premiums. They're the ones having that communication directly with that employee. And for the very reason you talked about it, if it is a disgruntled scenario, if the employer is handling it themselves, they're essentially collecting that premium from them every month. And there's an ongoing, whether it's dialogue, conversations, whatever it may be. Whereas if it's an administrator doing it, third party, the employer is kind of out of it. They're dealing with the administrator. Right.
And the employer is still sponsoring the plan, and it's still going to show up on your bill, by the way, employers. It's still, that Cobra employee is still going to show up, usually with a C beside it to indicate that the employee is on Cobra. But I think it's also a good practice if you have a third party administrator handling that. If the payment is not collected in a reasonable time, the third party can let you know, and then you can just simply terminate that employee. Exactly. And that way you don't get caught up in back premiums and, maybe canceling the employee after the fact or too prematurely.
Absolutely. Yeah. And that's really the key element with Cobra administration is managing the timelines, because there's so many of them.
Yes.
And so not just how long they can stay on, but then there's also how quickly the letter goes out, how much time the employee then has to decide if they want to elect, and then going back to their qualifying event date, what you mentioned, if they fail to make timely payments. There's just a lot of tracking.
Yeah. So if I'm a small employer here in Tulsa or Oklahoma City or really anywhere, I mean, you guys manage clients all across the United States. You don't have to just be local to Oklahoma. But if, that's something that I'm now crept up over 20 full-time employees, how could we get a hold of you? Are you accepting new clients? Like, what's the process?
Absolutely. So flexplanadmin.com is our website.
Okay.
Or, call me directly, 918-524-6321. Okay. But absolutely, we are there with their help. But we can talk to whoever that might be, the employee group, and it really, if they want to handle themselves, that's 100%. Like you said, it is an option. But there are also administrators such as us that can help too.
And I found that the cost to have assistance with that is fairly minimal.
Oh, absolutely.
Yeah. Well, thank you so much for your time, Darla. You got anything else to add to us?
I do not.
Nothing about Cobra. Thank you so much for your time, Greg. We appreciate you.
Appreciate you having me.
Disclaimer. Subjects that we discuss on the podcast are meant to be used as topics of conversation. All figures given are sheer examples. All information is subject to change and probably has changed since the airing of this podcast. Rates and figures change depending upon the demographic in which you live. Anything discussed in this podcast is our opinion. We do not represent Medicare, any governmental agencies, or any of the carrier partners on the show. Each person should do their own research on the various websites to ensure accuracy.